And whenever a company decides to buy back its stocks, it's very important we analyze the financial health of the company. So in this video, I want to talk about how stock buybacks reflects corporate financial health. How stock buybacks reflects corporate financial health. The relationship between stock buybacks and corporate financial performance is multifaceted and can have both direct and indirect effects on a company's financial health. So here is how buyback typically influence corporate performance. I want to talk about this video, under a number of subheadings. And number one is impacts on earning per share. In actual sense, corporate buybacks or stock buybacks boost earning per share. Stock buyback reduces the number of shares outstanding, which can increase earning per shares if earning remains the same. This can make company appear as profitable on a per share basis, often leading to positive market reaction and a possible increase in stock prices. There's a potential for misleading metrics. While earning per share may increase, it's important to consider whether the company's underlying profitability is improving or even the earning per share growth is simply due to a reduced number of shares outstanding. You need to balance the two. Number three is capital allocation efficiency. So in this case, we consider return on capital. Buybacks are way far. It represents a way, an avenue where companies try to return excess cash or excess capital to shareholders, especially when they have limited opportunity for reinvesting these funds. So if a company is returning capital to shareholders, rather than wasting it on some unprofitable ventures, I think it's a very good idea. It reflects a kind of capital efficiency. It reflects a kind of efficient way of allocating capital. We have an opportunity cost. There is opportunity cost. So if buybacks are prioritized over reinvestments to grow the company, further, example through acquisition or R&D or capital expenditure, this could limit the company's ability to drive long-term growth and value creation. That's what we need to consider. When the company gives out, cash to shareholders in form of stock buybacks, it limits its growth, and so the opportunity cost is actually quite high. Number three is then stock price performance, and there's always a potential for capital or for price appreciation. So when a company buys back its stocks, it can signal to the market that management believes the stock is undervalued, which may lead to increase demands on the stock, and that could cause the stock to climb. So reduced share counts can also enhance shareholder value, particularly if buybacks are timed during periods of markets undervaluation. Not only that, it is classified as a kind of short-term focused decision. Is that short-term focus? However, even the primary goal of buyback is to inflate stock price temporarily, it might not reflect genuine improvement in the company's financial performance or fundamentals. If the entire gimmick is to boost the share price in the short run, then that's kind of decision is will not augur well for the company's long-term prospects. Number four is improve financial ratios. This improve financial ratios like return on equity will then be improved. Buybacks can improve return on equity by reducing the equity, through share repurchasing, which might make the company returns appear stronger, even if the underlying returns on assets or operational performance remains unchanged. So it can somehow have a positive impact on return on equity. Not only that, it equally influences debt to equity ratio. So by reducing the number of outstanding shares, buybacks can also affect a company's debt to equity ratio. Companies may use buybacks to optimize their capital structure, but excessive buybacks funded by debt could increase financial risk. Is the buyback funded by debt, or is it funded by company's normal cash flow? You need to ask yourself the question. Please like this video and subscribe to this channel if you've not done that. Number five is tax efficiency. So you consider capital gain versus dividends. Usually, buybacks are generally more tax efficient than the company giving out issuing dividend payments for shareholders. This is because buybacks result in capital gains, which are often taxed at a lower rate than dividends. And so it tends to benefit long-term investors. Number six is investor sentiment. It's always that signal of confidence. It signals confidence. So when a company repurchases share, it often signals that management believes the stock is undervalued or the company has an excess capital. This can improve investor sentiment and attracts more investors, potentially increasing the share prices. Then there's confidence in stability. There's that particular, confidence that comes through perceived stability in the company. So regular and well-timed buyback can indicate that a company is in good financial health, and confidence in its it has confidence in its future fundamentals, and that will certainly leads to an increase in stock price as a result of returning value to shareholders. Number seven is management incentive and executive compensation. Management incentive and executive compensation. It is linked, to stock-based compensation. There could be a link. It might be linked to executive stock-based compensation. Buyback can benefit executive with stock-based compensation. Example, stock options. As a reduction in outstanding shares can make their stock options valuable. While this can align with executive interest, with shareholder interest, it might also raise concern if buybacks are done primarily with the intention of boosting stock price for executive gain rather than for the long-term growth of the business. Number eight, debt and financial leverage. Debt and financial leverage. In this case, there's an increased, leverage risk, increased leverage risk. So companies that take on debt to fund stock buybacks may increase financial leverage. While this can boost returns on the short term, it can also create higher financial risk if the company's business face downturn or if debt payment becomes too burdensome. In the case where the company borrows money to buy back shares, it's like increasing its debt burden. So in conclusion, stock buybacks can positively influence corporate financial performance by boosting earning per shares, improving key financial ratios, and signaling confidence, in the company's valuations.